Welcome back. You're watching a Power Lunch special. Interest rates in India Inc. Is what we're discussing. We've talked about the realty sector, which is not particularly happy with the RBI's measures. The market has taken it more or less in its stride, although the markets are trading down by about 0.7%. Autos is the other sector where you tend to see an impact of interest rates on demand in particular. Let's talk a little bit about that. Mr. Rohtash Mal is Executive Director and Chief Executive Officer at Escorts Limited, joining us on the phone line. Morning, sir. Thanks for joining us. Apologies we couldn't get you on live. But I wanted to get your thoughts. We were chatting about this, and you actually would not be entirely critical of what the RBI is doing. Are you saying you understand the need to control inflation even from a pure business perspective?
Well, it's between the devil and the deep sea, or a rock and a hard place. This is the 9th hike in 15 months, and it has impacted, 2.5%, whichever way you take it, retail finance or institutional finance. So while I understand the need to curb inflation, what I certainly do not understand is the over-reliance on only one lever, which is the monetary lever. I think a lot needs to be done on the supply side, getting our supply chains right. Now, if you talk about agriculture, it's crying for reform. So work needs to be done there. I mean, if you go back to the old radios, you had a big tuning knob and you had a fine tuning knob. The fine-tuning knob, i.e. the monetary policy, never did the job of the main tuning job, which is get the supply chain right. So while I understand that it had to come, and I am disappointed to a point, but a lot more work needs to be done on getting the supply chains right than merely focusing on this one lever called interest rates and jacking them up for the 9th time running.
That's a fantastic analogy, Mr. Mal. We need a fine-tuning knob, but in the absence of that fine-tuning knob, we're using interest rates. What's been the impact on the ground, sir? And we hear conflicting reports from corporates, and then we see something else in the data. You and your company are present across the chain in the auto sector. Where are you seeing the pain? What's being seen as resilient? Just help us through the ground reality.
I think it would be a misdefinition, if you like, sorry to coin that word, to be linked to the automotive space. Our products do have engines and transmissions in them, but we are not part of the automotive industry. We are actually part of the agriculture industry. So in the agriculture business, what is happening is the main drivers of demand for farm machinery, mainly the unavailability of labor. That is very much there and getting accentuated by the day as Rozgar Yojanas and other employment schemes start biting. Secondly, the government's move, and I think it's imminent, to look at minimum support prices in the light of increasing costs to farmers of diesel, irrigation and other transportation and so on. So minimum support prices, I assume, and I believe I would be correct, those would go up.
Yeah.
On the opposite side, retail finance did get cheaper, get more expensive. However, if you look at the impact on the EMI over 7 years, which is roughly the tenor that a tractor sells for, I see an impact, but it's not a huge impact. Loan disbursements are going quite well in our industry. And so, in a sense, I do not foresee major impacts on the side of sales. Now, when it comes to interest costs on the balance sheet, obviously it will have its impact. But we try and work on, and speaking for ourselves, we try and work on very lean working capital. So it's a bit of a mixed bag, mainly positive.
Just one last question, sir, and this is what we picked up from the realty companies who we had on before you. They're saying the problem is that you're not going to see any investment. So another year down the line, you'll see another price spike coming in because the capacities are simply not getting created. Would you tend to agree with that point at least?
Yes, I would tend to agree. If you notice the last 6 or 7 months of data which has come through the IIP and other tracking devices, you don't notice that there have been lower and lower rates of capital formation. On one side, in any case, food inflation was bothering us. The raw material hikes are there, the fuel hikes are there, and now the interest hikes are there. So in a sense, in a situation where demand may not be as buoyant as it was before, these things are sure to bite. In regard to formation of capital, indeed, in fresh investments.
All right, Mr. Mal, we'll leave it at that. Hope to get you on live for a longer discussion. But thanks so much for taking our call and
Thank
giving
you,
us
Ira.
your thoughts.